So we have this genuinely bizarre situation happening right now where the official economic headlines are telling us one story, but our bank statements are they're screaming something entirely different.
It's a complete disconnect.
Yeah, exactly. You open the news and the statistical bureaus are basically declaring victory. They're looking at their data, looking at the models, and saying, look, the consumer price index is falling. The worst is over.
Mission accomplished, right?
But then you, as the consumer, you walk into a supermarket, you put the exact same items in your basket that you did 2 years ago, and the bill at the checkout is still just aggressively climbing.
It's painful.
It is. You end up putting the name brand coffee back and reaching for the generic stuff just to keep your weekly budget from exploding. So there's this massive cognitive dissonance happening. The math on paper says things are cooling down, but the actual lived experience of trying to preserve your purchasing power feels harder than it has in decades.
Well, that cognitive dissonance is really the central tension of the materials we're analyzing today. The source documents we are working through, they represent a very comprehensive and honestly a highly critical examination of current monetary policy, taxation, and wealth preservation strategies.
And it's largely focused on Europe, right? Specifically the Netherlands.
Yes, specifically looking at the European landscape and the Dutch system, but, and I can't stress this enough, with massive global implications. The overarching theme across all these sources is that the traditional mechanisms for, building and protecting your wealth are fundamentally changing right underneath us.
Okay, let's unpack this. The goal for this deep dive is to basically map out that shifting landscape for you. We're pulling from a really dense stack of analysis today.
They really are. It covered a lot of ground.
Yeah, everything from supermarket inflation metrics to these incredibly complex proposed changes in Dutch wealth taxes, all the way out to macro cycles in gold and cryptocurrency.
Right, it's a wide net.
And just to set the tone, our objective here isn't to take a political stance or, tell you what to do with your portfolio.
No, absolutely not.
We're just here to dissect the arguments presented in these sources, look at the underlying mechanics of how these policies actually function in reality, and try to understand the structural forces at play. Because if you want to navigate this environment, you have to understand the why behind the headlines.
Exactly, which really requires us to dismantle how those headlines are constructed in the first place. I mean, the starting point of the source material tackles that exact supermarket disconnect you mentioned.
Right.
It focuses heavily on the reporting from the Dutch Central Bureau of Statistics, the CBS. The CBS has been putting out these reports indicating that inflation is experiencing a sharp decline.
Right, and they're largely attributing that drop to a decrease in motor fuel prices.
Yes.
The logic being gas is cheaper this month than it was a year ago. Therefore, hooray, the inflation crisis is subsiding.
That's the official narrative, yeah.
But the source immediately counterbalances that CBS narrative with consumer data from the Telegraph. And that data demonstrates widespread financial malaise. Consumers aren't throwing a parade for cheaper gas, right? They're structurally trading down their grocery habits because food prices remain incredibly elevated.
Yeah, people are feeling the pinch.
So mechanically, how do we reconcile a falling inflation rate with rising grocery bills?
Well, the reconciliation lies in the mathematical architecture of the consumer price index itself. I mean, when the CBS, or really any statistical body, reports that inflation is falling, they are referring to the year-over-year rate of change.
The derivative, essentially.
Exactly. The derivative of the price level, not the absolute price level itself.
I think, a lot of people intuitively grasp that, but it's the compounding nature of it that gets obscured by the headlines.
Spot on.
Like if we had 10% inflation last year, and this year inflation falls to 3%, prices didn't go down 7%.
No, not at all.
They went up an additional 3% on top of the already massively inflated prices from last year.
Right, and the source emphasizes this by pointing out the establishment of what they call higher bottom.
Higher bottoms, yeah.
Even if the headline inflation rate drops from a peak of, say, 8% down to 2.9%, that 2.9% is still compounding on a vastly expanded base.
It's terrifying when you actually run the math on it.
It is. And furthermore, that 2.9% remains significantly above the European Central Bank's mandate of 2% for price stability.
Right.
So the baseline cost of living has undergone a permanent upward paradigm shift. The floor has been raised permanently.
And leaning so heavily on a volatile commodity like oil to declare victory just seems incredibly fragile. I mean, the source dives into the geopolitical backdrop to show how quickly that variable can just completely flip.
Yeah, the reliance on energy prices to anchor the CPI narrative is a major vulnerability, and the text really highlights this. They provide a timeline of recent geopolitical events to illustrate that fragility.
Walk us through that timeline.
Well, there was a specific window recently where rumors of peace talks between the United States and Iran caused a temporary dip in global oil prices.
Okay, so oil goes down temporarily.
Right. And the statistical agencies immediately incorporated that dip, and boom, the headline inflation numbers suddenly looked very favorable.
But the reality on the ground was already moving in the opposite direction.
Completely.
Yeah.
I mean, the ink on those reports barely dried before the situation escalated again. The source notes that following over 160 attacks in strategic maritime straits, those interim diplomatic deals were effectively dead on arrival.
Wow. 160 attacks.
Yeah. And oil prices immediately reversed their downward trend and spiked right back up to $80 a barrel, severely disrupting commercial traffic in some of the most critical logistical waterways on the planet.
So the headline inflation number was essentially just a snapshot of a temporary geopolitical lull. It was completely ignoring the structural supply chain risks that were actively materializing right at that moment.
Exactly. It was a statistical mirage.
But, even if we factor in that oil spike to $80 a barrel, there is still a mechanical delay, right?
Yeah.
Like when I read the source's breakdown of how these costs ripple through the economy, this concept of a transmission delay really clarified for me why the supermarket feels so disconnected from the commodities market.
Yeah, the transmission delay is arguably the most crucial mechanism for understanding the consumer experience right now. The global spot price of a commodity like crude oil or wheat that just represents the absolute beginning of a very long, very complex supply chain.
Let's actually trace that out. Give me a real-world analogy. Because if the price of crude oil jumps 10% today, the logistics company delivering goods to my local supermarket doesn't instantly hike their rates by 10% this afternoon.
No, of course not. They have fixed price contracts for fuel. They use hedging strategies. They have negotiated freight rates that are locked in for a quarter, maybe even a full year.
Right.
And that acts as a buffer, but eventually those contracts expire.
And then reality hits.
Exactly. When the logistics company has to renegotiate, they absorb those higher energy costs. Then they pass those costs on to the production facilities, the factories, and the processing plants.
Okay, so now the factory is paying more for shipping.
Right. And those facilities are also dealing with their own expiring utility contracts for electricity and gas, so their internal operational costs are rising simultaneously.
And they can't just instantly hike the price of a box of cereal, right? Because they also have negotiated wholesale contracts with the massive supermarket chains.
Which adds yet another layer of delay. The factory absorbs the margin compression for as long as they can physically manage it, or at least until their contracts allow for price adjustments. Then finally, they pass the cost to the supermarket.
Wow.
And then the supermarket, facing higher wholesale prices and higher costs to keep their own lights and refrigerators running, they finally adjust the retail price on the shelf.
So by the time I'm standing in the aisle, looking at the price tag of that cereal, I am not paying for today's inflation.
Not at all.
I am paying for the accumulated, compounding friction of every single energy and logistical price hike that occurred over the preceding, 6 to 12 months?
Exactly. The consumer is always the last link in the chain to feel the impact, which means consumer prices are a trailing indicator.
A massive trailing indicator.
Yeah. And the source argues this is exactly why the CBS can report a localized short-term drop in the inflation rate due to a dip in wholesale fuel, while the consumer is simultaneously getting crushed by the delayed tsunami of all those previous input costs finally reaching the checkout counter.
And that structural increase in the cost of daily life isn't just, an inconvenience. It's generating quantifiable financial distress across the population.
Severe distress.
Yeah. The source pivots from the macro mechanics of CPI directly into the microeconomic reality of households, and they use data from NIBD, the National Institute for Family Finance Information.
Right. And the NEBD statistics presented in the material illustrate a truly rapid deterioration in financial stability. According to their data, 38% of Dutch households currently report struggling to make ends meet.
38%. That is nearly 4 out of every 10 households.
Yeah.
And the velocity of that trend is what really struck me. The source note that this figure is up from 32% just a short time prior. A 6% jump in structural household distress is a massive systemic red flag.
It's huge.
But the demographic breakdown is even more concerning. The demographic experiencing the most acute financial problems right now are young adults in their 20s.
Which presents a severe long-term macroeconomic risk for the whole country. I mean, the 20-something demographic is theoretically the foundation of future economic expansion.
Right, they're supposed to be building their lives.
They are in the wealth accumulation phase. But if they're entering the workforce and immediately drowning in structural living costs, their ability to generate capital, invest, and sustain the broader economy is just completely paralyzed.
And the source points a very firm finger at the educational system for this vulnerability.
They do, yeah.
The argument isn't just that things are expensive, it's that young people are entering this environment completely unarmed. There is a total absence of foundational financial literacy in the standard curriculum.
The critique is really that the education system adequately prepares students for their specific academic or vocational fields, but it completely neglects the mechanics of operating within a fiat monetary system.
Which is pretty important.
Extremely. They understand how to earn a salary, but they do not understand the mechanics of purchasing power, inflation, or asset allocation.
Which creates a massive knowledge vacuum. And the source makes the case that this vacuum is being aggressively filled by social media. Because the educational system isn't teaching them how to build sustainable wealth, young people are turning to finfluencers.
Oh, the finfluencers.
Yeah, these online financial influencers who are essentially selling a mirage.
The material highlights the predatory nature of that ecosystem. Finfluencers often prey on the legitimate financial anxiety of the youth by peddling these extreme luxury illusions. The rented Lamborghinis, the promises of overnight wealth through highly speculative trading courses.
So flash.
Right. It redirects their anxiety into high-risk, low-probability gambles rather than teaching the boring mathematical realities of long-term compounding.
But the source does highlight a moment of clarity from the youth demographic, which was interesting. There's a reference to an opinion piece written by a student in the FD, the Financial Times of the Netherlands.
Ah, yes.
And the student basically distilled the entire macroeconomic situation into one incredibly stark sentence they wrote. Not investing means a guaranteed loss of purchasing power.
And if we connect this to the bigger picture, that single sentence really encapsulates the core thesis of the first half of the source material. It represents a fundamental shift in how we have to view financial risk.
Let's explore that shift. Because the traditional advice, the conventional wisdom that most of us grew up with, is that keeping your money in a savings account is the safe option, right?
That's what we're all taught.
You don't risk your principal. If you put $10,000 in the bank, you know for a fact you will have $10,000 next year. Investing in the stock market is viewed as the risky option where you could lose your shirt.
But the source argues that in an environment of structural inflation and higher bottoms, that traditional definition of risk is completely inverted.
Right.
If inflation is running at a real rate of, say, 4% or 5%, and your bank account is yielding 1% or 2%, the nominal number in your account might stay the same.
The digits don't change.
Right, the digits are there, but the purchasing power of that capital is mathematically guaranteed to contract. So holding cash is not a risk-free position. It is a guaranteed negative real yield.
It's the illusion of safety. You aren't losing the digits on the screen, but you're losing the actual utility of the money. But the psychological barrier to crossing over into investing is massive, especially right now. When people look at the macroeconomic landscape, we have wars, we have central banks manipulating interest rates, we have warnings of impending recessions. The natural human instinct is to hoard cash.
It's self-preservation.
Right. People try to time the market, they sit in cash, convinced a crash is coming, waiting to buy in at the absolute bottom.
And the source directly attacks that fallacy of market timing. They rely on historical data to demonstrate just how detrimental that psychology is to long-term wealth preservation.
Let's break that down.
The material looks at the structural realities of market cycles over the last 75 years to basically reframe the perceived risk of equity markets.
Walk us through that data, because the contrast between the duration of growth periods versus decline periods is striking.
It really is. The analysis focuses on the broad market averages over 3/4 of a century. And the data reveals that the average bull market, so the periods of sustained economic and market expansion, lasts approximately 5 years.
Okay, 5 years of growth.
Right. And during those 5-year periods, the average cumulative price increase across the market is roughly 250%.
So a half-decade of consistent, aggressive compounding.
Yes. Conversely, the average bear market, the periods of severe market contraction and panic last, on average, just 1 year.
1 year.
1 year. And the average total drawdown during that 1-year period is approximately 30%.
The asymmetry there is just wild.
It is entirely asymmetrical. But the most critical statistic the source provides to combat the fear of market timing is the recovery time.
Let's hear it.
Even if an investor had the absolute worst timing imaginable, if they deployed all their capital at the absolute peak of a market cycle, literally the day before a massive crash, the median time it takes for a broad market portfolio to fully recover its previous all-time high is just 2.1 years.
Okay, let's apply that to the person hoarding cash today. They are sitting on the sidelines for 3, 4, or 5 years, terrified of a potential 30% drawdown that might last a year.
Right.
And in doing so, they are actively missing out on a cycle that historically yields hundreds of percent in upside, while inflation silently eats 15% or 20% of their cash's purchasing power over that exact same waiting period.
They are accepting a guaranteed permanent loss of purchasing power to avoid a temporary, mathematically recoverable volatility in asset prices.
It makes no logical sense when you spell it out like that.
No, it doesn't. And the source argues that the only viable escape hatch from this structural inflation trap is consistent, long-term participation in the equity markets.
And importantly, the material doesn't suggest people need to become professional day traders to achieve this, right?
Oh, God, no.
It leans heavily into the absolute most boring, passive strategy imaginable. The simple index tracker.
Yeah, the recommendation discussed in the source is the utilization of a broad market index, such as the S&P 500, and the underlying math is very compelling. Over a 30-year horizon, the S&P 500 has averaged an annualized return of approximately 10%, prior to taxation and inflation adjustments.
Which outperforms the vast majority of highly paid active fund managers on Wall Street.
Consistently, year after year. And the source actually provides a granular microeconomic example of this strategy in practice to prove its accessibility.
The Trade Republic example.
Yes, the narrator details their own experience setting up an automated savings plan on a platform called Trade Republic.
Right. They committed to a completely passive strategy. The source says that 2.5 years ago, they set up an automated transfer to invest exactly 300 euros every single month into a globally diversified, all-world ETF.
A classic set-it-and-forget-it approach.
Exactly. They didn't try to time the market. They didn't adjust it based on the news cycle. Just a blind monthly allocation.
And despite the significant global market volatility over the last 2.5 years, and there has been a lot of volatility, the results of that simple dollar-cost averaging strategy are very robust.
What were the numbers again?
The total capital invested accumulated to a portfolio value of roughly 11,600 alive, which represents an absolute price increase on the invested capital of nearly 25%.
So while the cash sitting in a bank account would have lost significant purchasing power to the inflation spikes we saw over the last 2 years, this automated 300-a-month strategy successfully outpaced inflation and generated real wealth.
It is a perfect practical demonstration of that, students quote. Participating in the market is the only mathematical defense against the erosion of fiat currency.
Okay, so the logic thus far is airtight. The cost of living is structurally rising. Holding cash is a guaranteed loss. The historical mathematical solution to preserving purchasing power is long-term passive investment in broad equities.
Exactly.
But this is the exact moment where the source material takes a very dark turn.
Yes, it does.
Because what happens when an individual understands all of this, does everything right, takes the responsibility to invest for their future, and then the state decides to completely rewrite the taxation rules governing those investments.
Yes. This brings us to the centerpiece of the source's critique. The proposed overhaul of the Dutch wealth tax system, colloquially known as the Box 3 reform. Yeah. And the intensity of the analysis here suggests that this isn't just a minor policy tweak. The source views it as a fundamental threat to the viability of private wealth accumulation.
Let's build the foundation of this argument first, because the source anchors its entire critique of Box 3 on a very basic principle of economics regarding taxation and behavior.
The foundational premise is that taxation is primarily a mechanism for behavior modification. The axiom is simple. Taxing things reduces them.
Right.
If a government wants to reduce carbon emissions, they implement a carbon tax. If they want to decrease tobacco consumption, they raise taxes on cigarettes. The tax creates friction, which disincentivizes the activity.
So the logical extension the source presents is, if a government implements highly aggressive, friction-heavy taxes on the investment sector, they are actively disincentivizing capital allocation.
Precisely.
They are punishing the exact people who provide the liquidity that businesses need to expand, to hire workers, to develop new technologies.
The argument is that heavily taxing investment capital ultimately strangles the broader economic engine. But to understand why the source is so vehemently opposed to this specific reform, we really have to contrast the historical tax structure with the proposed new reality.
Let's get into the mechanics, because the Dutch system is notoriously intricate. Historically, how was wealth in Box 3 taxed?
Okay, so under the old regime, the Dutch government didn't look at your actual brokerage account to see how much profit you made on a specific stock trade.
They didn't care about your actual gains.
Nope. Instead, they use a system of fictitious or presumed returns.
Fictitious returns, that just sounds crazy.
It does. They basically looked at your total net wealth, categorized it into savings or investments, and then applied a statutorily defined presumed percentage of return to that wealth. You then paid a tax rate on that imaginary return, regardless of whether your portfolio actually went up 20% or down 10% in reality.
Which sounds incredibly arbitrary. If the market crashes and I lose money, but the government spreadsheet assumes I made a 4% return, I have to pay tax on a profit I didn't actually make.
Yeah, it was heavily criticized for exactly that reason, and the Dutch Supreme Court eventually ruled that the system of fictitious returns was legally untenable in certain contexts.
Because it violated property rights.
Exactly, by taxing returns that fundamentally didn't exist. This legal defeat is what forced the government to design a new system.
And the proposed solution, the new Box 3 reform, is supposed to shift from taxing fictitious returns to taxing actual returns.
Right.
And on the surface, that sounds infinitely more equitable. If I make a profit, I pay a tax on that profit. If I don't, I don't. So where does the source find the fatal flaw in this new design?
The fatal flaw, according to the analysis, is the government's definition of a return.
Uh-oh.
The proposed legislation, the Aanwasbelasting, does not limit itself to taxing realized capital gains. It explicitly aims to tax unrealized paper profits.
Okay, let's slow down and make sure we completely unpack this, because taxing unrealized gains is a massive conceptual leap.
It's huge.
Let's run a hypothetical. Let's say I take 10,000 euro and buy shares in a technology company on January 1st. The company's had a great year, and on December 31st, those exact same shares are now valued at 15,000 euro on the open market.
Okay, under a traditional capital gains tax system, like you see in many other jurisdictions, you owe nothing on December 31st.
Right.
You have a 5,000 euro unrealized gain. It is a paper profit. You only trigger a taxable event when you actively choose to sell those shares and convert that paper profit back into realized fiat currency.
Because until I sell, the value could crash the next morning. I haven't actually locked in the economic benefit.
Precisely. But under the proposed Box 3 reform detailed in the source, the government assesses the value of your portfolio on December 31st, sees that your asset appreciated by 5,000 euros, and demands you pay a percentage of that 5,000 as tax immediately.
Which introduces a massive logistical nightmare that the source calls the liquidity trap.
The liquidity trap, yes.
Because if I owe tax on that 5,000 euro paper profit, but all my money is tied up in the shares, how do I pay the government? I don't have the cash.
And that is the exact friction point the source highlights. If you do not possess sufficient liquid cash reserves outside of your investment portfolio to cover the tax liability on your paper gains, you are legally compelled to liquidate a portion of your assets.
You have to sell.
You have to sell your shares, potentially at a very inopportune time in the market cycle, solely to generate the cash to pay the tax.
But that completely shatters the foundation of long-term financial planning. I mean, any financial advisor will emphasize the importance of asset allocation. The source mentions the classic model, right?
The one-third model, yeah.
A portfolio divided into thirds. 1/3 in fixed income or bonds for stability, 1/3 in equities for growth, and 1/3 in cash for liquidity and emergencies.
Well, if the state forces you to perpetually siphon cash out of that portfolio to pay taxes on unrealized equity growth, your carefully constructed allocation is structurally undermined year after year.
The compounding effect is severely stunted because your capital base is constantly being reduced by forced liquidations.
Exactly. And the asymmetry of the system is brutal. The source points out the chronological risk here.
What happens in year 2? Let's say I paid the tax on that 5,000 euro paper profit in year 1. But in year 2, the broader market enters a recession and the value of those shares plummets back down to 10,000 a year.
Well, you have now paid hard cash to the state for a theoretical profit that has subsequently evaporated.
Oh my God.
You are holding an asset that has generated zero net return over 2 years, but you are poorer because you suffered the tax extraction in year 1. The source argues this creates an environment of extreme hostility toward private investment.
which raises the question of political messaging. Because historically, when a government implements a wealth tax or aggressively targets investment returns, it is universally marketed to the public as a tax on the super rich.
Oh, always.
It's always framed as closing loopholes for billionaires and oligarchs who aren't paying their fair share.
And the source aggressively dismantles that narrative regarding Box 3. It argues that framing this reform as a wealth tax on the ultra-rich is a deliberate political misdirection.
A misdirection.
Completely. According to the demographic data cited in the analysis, this tax reform directly impacts approximately 30% of the entire Dutch population.
That is not the top 1%.
Not even close.
30% of the population is essentially the entirety of the middle to upper middle class. That is a massive demographic footprint.
It is. And the source drills down into exactly who makes up that 30%. A significant portion of those impacted are small business owners and freelancers, referred to as ZZP'ers in the Netherlands.
This is a crucial distinction, because if you work for a multinational corporation, or if you are a civil servant, you generally have a robust, employer-sponsored pension plan working in the background. You contribute, your employer contributes, and it is managed institutionally.
Right. But an independent freelancer or a small business owner does not have that institutional safety net. They are solely responsible for capitalizing their own retirement.
So they have to build their own pension.
Exactly. The source explains that these entrepreneurs typically utilize their business entities, their Box 2 or BV structures, to retain earnings, invest those earnings in the market, and build their own private pension reserves.
And the source notes that this exact demographic of small business owners has already been under immense pressure. Their net profit margins have been compressed for 3 consecutive years due to the structural inflation we discussed earlier, rising material costs, and higher energy bills.
So they are facing compressed margins in their active businesses, and now the government is proposing a tax structure that will aggressively erode the passive investment returns they are relying on for their future survival.
Wow.
The source argues that Box 3 isn't a tax on oligarchs. It is a direct assault on the retirement security of the entrepreneurial middle class.
And the mathematical evidence for that argument is found in how the exemptions are being restructured.
Wow.
I want to really take our time and walk through the numbers the source provides here, because the shift in the threshold is staggering.
It really exposes the math.
Proponents of the reform claim that it is designed to protect small, everyday retail investors. Let's look at the actual data.
Okay, the comparison between the old exemption and the proposed new exemption is stark. Under the old Box 3 regime, there was a hard nominal wealth exemption limit. For a partnered couple filing jointly, the first $120,000 of total invested wealth was entirely exempt from taxation.
So a couple could spend a decade diligently saving, build up a $100,000 portfolio in index funds for their retirement, and the state would levy zero wealth tax on that capital.
Correct. The tax only applied to presumed returns on capital exceeding that $120,000 threshold. It provided a substantial safe harbor for middle-class accumulation.
And the new system.
Under the proposed new system, that nominal wealth exemption is completely abolished. Entirely gone. It is being replaced by a tax-free return exemption capped at just 1,800 euros per year.
Okay, we need to run the math on this to show exactly how low that threshold is. Let's use the historical average we discussed earlier for a broad market index. Let's assume a young investor has capital deployed in the S&P 500, and they experience an average year with a 10% return on their investment.
If the market yields a 10% return, an individual with a total invested portfolio of just $18,000 would generate exactly $1,800 in profit.
So at a portfolio size of just $18,000, they have already entirely exhausted the new tax-free exemption limit.
Precisely, which means that any capital invested above that $18,000 mark is fully exposed. If they have $20,000 invested, generating a $2,000 profit, the $200 of profit above the exemption is taxed at the proposed flat rate of 36%.
That is a 36% tax rate kicking in at a wealth threshold that is nearly 85% lower than the old system.
Yes.
Even if we assume a much more conservative return, say they are heavily invested in bonds yielding just 5%, they still exhaust the 1,800 exemption once their portfolio hits 36,000 euros.
The math unequivocally supports the source's assertion. The proposed system radically lowers the threshold for taxation, dragging millions of small-scale investors, young people trying to build initial capital, and middle-class savers into a highly punitive tax bracket on unrealized gains.
If the math is this hostile to the middle class, and the logistical nightmare of taxing unrealized gains is this complex, why is the government pushing so hard for this specific architecture? What is the underlying motivation driving this policy?
The source identifies the driving force as a concept called budget neutrality.
Explain that.
Well, the historical legal challenges that defeated the old system of fictitious returns, combined with the administrative costs of transitioning to a new system, created a substantial projected shortfall in the government's long-term budget.
How big of a shortfall?
The source cites an estimated structural gap of $22 billion looking out toward 2036.
So the government has a $22 billion hole in their future projections.
Exactly. And the mandate for the Ministry of Finance when designing this new Box 3 reform was budget neutrality, meaning the new system must be calibrated to extract the exact same amount of total revenue that was originally projected under the old, now illegal system.
Regardless of the economic collateral damage it causes to the investment climate.
Correct. They have a number they need to hit.
They are managing the economy like an Excel spreadsheet. They see a negative cell, so they just arbitrarily increase the percentage in the tax cell until the bottom line zeroes out.
And the source heavily criticizes this static view of policy design. It assumes that the economy is a closed system and that citizens will simply accept the new variables without altering their behavior.
But history and psychology prove that humans do not operate like inputs on a spreadsheet. When the rules of the game change, especially when those changes are perceived as unfair or confiscatory, people react.
Absolutely react.
They change how they play. And the source dives deep into this behavioral aspect, referencing a concept called Homo economicus.
Right, Homo economicus. It's a foundational theoretical model used in classical economics. It posits that a human being is a perfectly rational, hyper-calculating agent who will always make the mathematically optimal decision to maximize their utility, devoid of emotion, spite, or context.
It is the assumption that humans are essentially algorithms.
Yes. And the source argues that bureaucratic policymakers rely entirely too much on this myth when designing tax frameworks. They assume that if they raise the tax rate on investments to 36%, Homo economicus will just run the numbers, realize that investing still yields a slightly positive net return compared to holding cash, and rationally continue to invest and pay the tax.
But the source uses a brilliant everyday analogy to expose the flaw in that thinking. They use the psychology of a grocery store.
I love this analogy.
Let's say you go to the supermarket on a Tuesday, you have your meal plan, you have your budget, and you fully intend to buy a bag of frozen peas. You walk down the aisle, and you discover the supermarket has arbitrarily doubled the price of peas overnight.
How does Homo economicus react?
Homo economicus analyzes the nutritional density of the peas, calculates the caloric value per euro even at the doubled price, determines it is still technically the most efficient purchase for the planned recipe, and rationally puts the peas in the cart.
But how does a real human being react?
A real human being looks at the price tag, feels a visceral sense of being gouged, and out of sheer annoyance and spite, refuses to buy the peas.
Exactly.
They pivot, grab a bag of broccoli instead, and change their dinner plans. Even if the broccoli is slightly less optimal, they change their behavior because they refuse to participate in a transaction that feels fundamentally unfair. We are highly emotional, reactive creatures when it comes to our money.
And when you apply that behavioral reality, that spite and reactance to macroeconomic taxation, you enter the territory of the Laffer curve.
The Laffer curve is central to understanding why the spreadsheet approach to budget neutrality fails. Break down the mechanics of the curve for us.
The Laffer curve is a theoretical representation of the relationship between government tax rates and the resulting total tax revenue collected. The extreme ends of the curve are obvious. If a government sets the tax rate at 0%, they collect zero revenue.
Logically.
Conversely, if a government sets the tax rate at 100%, they also collect zero revenue.
Because if the state confiscates every single euro of profit, no one has any incentive to work, produce, or take investment risks. The economy stops completely.
Exactly. Therefore, the optimal revenue generating point lies somewhere on the curve between 0% and 100%. However, the critical insight of the Laffer theory is that there is an apex, a tipping point.
What happens at the apex?
If a government continually raises tax rates past that apex, the friction becomes too great. The behavioral changes outweigh the higher rate, and total tax revenue actually begins to decline.
You trigger the macroeconomic equivalent of the broccoli response. People refuse to buy the peas.
Exactly. The source argues that the proposed Box 3 reform pushes the system far past the apex of the Laffer curve. When the taxation of unrealized gains becomes perceived as punitive and logistically absurd, investors don't just passively pay it, they actively restructure their behavior to avoid it.
And a source outlines exactly what that capital flight looks like. Some people will simply hoard cash, accepting the loss to inflation just to spite the tax man.
Spite is a powerful motivator.
It is. Others will initiate aggressive gifting strategies, transferring wealth to their children decades earlier than planned to get it out of their taxable estate.
Right. The wealthier demographics will hire specialized accountants to design complex corporate holding structures or offshore trusts to shield the capital. And in the most absolute expression of the Laffer curve, you see physical emigration.
Just leaving the country.
Capital is globally mobile. Entrepreneurs and investors will simply pack up, liquidate their local ties, and move their residency and their capital to jurisdictions with favorable tax regimes.
The source quotes sentiment from the entrepreneurial sector, with business owners explicitly stating, "I'm going to pull all my liquidity out of box 3. I will stop investing in the local market because I refuse to subject my capital to this system."
Yeah.
That is an emotional, spite-driven decision that starves the domestic economy of the capital required for innovation and growth.
The government is so focused on filling a $22 billion spreadsheet hole that they risk causing a broader economic contraction that will cost them significantly more in lost corporate and income tax revenue over the long run.
Which is why the source doesn't just complain. It proposes a highly counterintuitive alternative solution directly to the Ministry of Finance. The source argues that if the government truly needs to close a budget gap quickly, they shouldn't be designing labyrinthine traps for unrealized gains.
No.
Instead, they should temporarily lower the Box 2 dividend tax rate.
This proposal represents a dynamic understanding of economics, focusing on the velocity of money rather than static extraction.
Let's trace the mechanics of that idea. How does lowering a tax rate actually generate a massive influx of revenue?
Well, it addresses the stagnant capital locked inside corporate structures. Right now, because the dividend tax rate is high, many successful entrepreneurs and business owners choose to leave their accumulated profits sitting dormant inside their corporate entities, their BVs.
Right.
It sits on the balance sheet relatively unproductive because the tax penalty for distributing it to their private accounts is just too steep.
It's essentially a massive reservoir of trapped liquidity.
The source argues that if the government announced a temporary one-year window where the dividend tax was substantially reduced, it would act as a massive behavioral catalyst. The incentive structure flips.
Oh, I see.
Business owners would rush to pull that dormant capital out of their holding companies and into their private possession while the discount applies.
So the government takes a smaller percentage cut, but they take it on an exponentially larger volume of capital that was otherwise never going to be taxed in the near term anyway.
Exactly.
The sheer volume of transactions creates an immediate windfall of tax revenue that could plug the budget gap.
But the macroeconomic benefits extend far beyond the immediate tax receipt. Once that trapped capital is liberated into private hands, the velocity of money accelerates. What do individuals do with sudden, large injections of private liquidity?
They inject it into the real economy. They remodel their homes, which employs local contractors, buys materials, and generates sales tax. They buy new vehicles. They provide angel investments to local startups, which funds payrolls and creates new jobs.
Yes. The capital goes from being a static line item on a corporate balance sheet to actively circulating through the economy, generating multiple secondary and tertiary taxable events at every single step.
It's the difference between trying to squeeze blood from a stone versus opening a dam and letting the water flow. The pie expands, so even with a thinner slice, the state collects more total revenue.
That's a theory, yeah.
But the government's focus isn't solely restricted to the wealth people are currently managing and investing. The source material takes a significant pivot into the future, analyzing how the state views the wealth that is eventually left behind.
Right, inheritances.
And this brings us to a demographic phenomenon that is actively reshaping global economics.
Yeah.
The greatest generational wealth transfer in human history.
The scale of this macro event is frankly difficult to comprehend, but the source utilizes data from UBS, the global wealth management firm, to put parameters around it.
What are the numbers?
We are currently entering a 20-year demographic window where the baby boomer generation is beginning to pass away.
And this is a generation that experienced an unprecedented multi-decade golden age of economic expansion, real estate appreciation, and equity market growth. They hold a wildly disproportionate percentage of total global assets.
According to the UBS projections cited in the material, over the next 2 decades, this demographic cohort will transfer an estimated $83.5 trillion in accumulated wealth to the next generation globally.
$83.5 trillion.
Trillion. With a T. And zooming in on the Netherlands specifically, the source notes that roughly 1 trillion of that wealth transfer will occur domestically.
It is a systemic generational movement of capital. And naturally, a government facing structural deficits and demographic pressures is going to look very, very closely at an ocean of liquidity moving from one generation to the next.
Which is where the source raises a highly critical analysis of political maneuvering and the manufacturing of public consent.
Yeah, this part was fascinating.
The source points to a specific report published by the CPB, the Central Plan Bureau, which functions as the primary economic analysis and forecasting agency for the Dutch government.
And right at the exact moment this massive impending wealth transfer is dominating financial headlines, the CPB releases a report regarding inheritance taxes.
What a coincidence.
Right. And the headline conclusion of this state-sponsored report is that the majority of the Dutch public actually supports the implementation of higher inheritance taxes on large estates.
From a political perspective, that is an incredibly convenient finding. If a government wants to tap into that 1 trillion transfer to fund its liabilities, they need political cover.
Absolutely.
A report claiming the public demands this provides the perfect justification for raising rates.
But the source does not take that headline at face value. They dig into the underlying methodology of the CPB report, and they uncover a massive chronological discrepancy.
The analysis reveals that the CPB report utilized opinion polling data collected in 2023 while relying on factual tax receipt data from 2022. The foundational data points were years out of date by the time the report was weaponized in the current debate.
And the source completely shatters the CPB's narrative by comparing it to a contemporary real-time data point. The AD, which is a major, widely circulated Dutch daily newspaper, conducted its own massive reader poll asking the exact same question regarding support for higher inheritance taxes.
And the contrast in the results is staggering. The AD poll, which captured responses from over 34,000 active readers, concluded that nearly 80% of respondents were vehemently opposed to any increase in inheritance taxation.
So the state agency claims a majority wants the tax, while an independent poll of 34,000 citizens shows an 80% rejection rate. The source leverages this discrepancy to argue that the CPB report was not an objective economic analysis, but a calculated political instrument designed to manufacture consent for wealth confiscation.
What's fascinating here is that this disagreement exposes a much deeper underlying philosophical fault line in how society views the concept of inheritance itself.
Let's look at this neutrally and examine the core values driving both sides of this debate. What is the fundamental ethical argument driving the desire to heavily tax inheritances?
The pro-tax argument is deeply rooted in the sociological pursuit of equalizing opportunity. The premise is that a substantial financial inheritance represents a structural unearned advantage. If 2 children are born on the same day, and one inherits a multi-million-euro trust fund while the other inherits debt, the meritocratic playing field is fundamentally corrupted from day one, regardless of either child's work ethic or intelligence.
It views concentrated multi-generational wealth as a systemic flaw that inevitably leads to oligarchy. And the mechanism to correct that flaw is the state intervening at the point of transfer, taking a significant percentage of that accumulated wealth and redistributing it across society to fund baseline equalizers, things like robust public education, infrastructure, and universal health care.
Right.
It's the idea that society as a whole has a stronger claim to that capital than the genetic lottery winner.
That is the core egalitarian perspective. However, the source offers a fiercely contrasting viewpoint, one that challenges the very definition of what a family unit is supposed to accomplish.
And the counterargument is fascinating because it moves away from pure economics and into evolutionary and social biology. The source argues that the entire concept of a parent providing equal opportunity compared to the rest of society is a fallacy.
The biological and social imperative of a parent is inherently discriminatory. Parents are biologically driven to provide their specific offspring with every possible unequal advantage they can muster. And this extends far beyond financial capital.
Exactly. A parent provides an unearned advantage by spending 2 hours a night helping their child with math. They provide an advantage through emotional stability, by instilling discipline, by transferring the cultural knowledge of their social network.
Right.
A child who grows up in a stable home with parents who read to them have a massive, unearned developmental advantage over a child who doesn't.
But the state does not attempt to quantify or tax the transfer of parental time, discipline, or love. The source argues that financial inheritance is simply the quantifiable monetary extension of that exact same parental imperative. It is the final manifestation of a family's responsibility to secure its lineage.
Furthermore, the source highlights the punitive nature of the tax on the virtues of sacrifice. Think about a small business owner. They spend 40 years working 70-hour weeks. They don't take lavish international vacations. They drive a 10-year-old car.
They grind.
They reinvest every spare euro back into building a local manufacturing company, specifically with the vision of handing a secure asset to their children.
They deferred immediate gratification to build generational stability.
And then they pass away. And the state arrives and assesses the illiquid value of that manufacturing company and demands 30% or 40% of its value in cash within a matter of months.
Which often forces the grieving family to liquidate the asset entirely or take on massive corporate debt just to satisfy the tax liability. The source argues that this dynamic aggressively destroys the incentive for long-term multi-generational thinking. If the state is guaranteed to dismantle the legacy upon death, why bother deferring gratification? Why build a family enterprise at all?
And the geopolitical reality of inheritance taxes is that they often fail to achieve their intended goal of taxing the ultra-wealthy. The source contextualizes this by looking at the broader European landscape, returning to the concept of capital mobility.
The European map of inheritance taxation is highly fragmented. While jurisdictions like France and the Netherlands maintain very aggressive, high-percentage inheritance tax regimes, others have recognized the futility of the exercise.
Like who?
Nations like Italy and Portugal have reduced inheritance taxes to near zero for direct descendants. A significant portion of Eastern Europe has abolished the tax entirely.
And capital, like water, flows to the path of least resistance. The source references findings from the OECD, the Organization for Economic Cooperation and Development, which highlight a persistent paradox.
The paradox is that despite aggressive statutory rates, inheritance taxes consistently yield surprisingly low total revenue relative to the overall tax base. The reason for this inefficiency is structurally obvious. The ultra-wealthy, the multi-billionaires who are the theoretical targets of these taxes, possess the resources to legally bypass them.
They don't just leave €1 billion in a standard checking account. They deploy legions of lawyers and accountants. They utilize complex, multi-jurisdictional trust structures. They set up corporate holding companies that never technically die.
Right.
They execute sophisticated tax-free gifting strategies over decades. Or, as we discussed with the Laffer curve, they simply alter their legal residency to Portugal or Italy in the final years of their life, completely removing their capital from the Dutch or French tax base.
Which means the aggressive inheritance tax completely misses the oligarchs. Instead, the burden lands squarely on the upper middle class. It hits the family that owns a moderately successful local restaurant or a mid-sized agricultural farm.
Their wealth is entirely tied up in illiquid physical assets. They can't move their farmland to an offshore trust in the Cayman Islands. They become the primary victims of a tax designed to target billionaires. It becomes a tax on the immobile middle class.
To squeeze.
Let's synthesize where we are in the narrative, because the picture the source paints is incredibly intense. As an individual trying to navigate this economy, you are facing structural inflation eroding your cash. You are facing proposed Box 3 taxes that aim to confiscate your unrealized investment gains. And if you survive all that, the state is actively debating how much of your remaining wealth they will extract upon your death.
It portrays a traditional financial system that is becoming structurally hostile to the preservation of private property.
Which perfectly explains the final major transition in the source material. If the traditional avenues of fiat currency, savings accounts, and government-regulated equities are under siege, capital is forced to seek out alternative vehicles for preservation.
Right.
It seeks out assets that operate outside, or at least adjacent to, the immediate control of the state apparatus.
This leads the analysis directly into the macroeconomic cycles of commodities and cryptocurrencies, the original hard money and the digital hard money.
Let's start with gold. The source addresses a massive paradox regarding gold right out of the gate. We have spent the last hour discussing how sticky and persistent inflation is. Gold has been humanity's primary hedge against inflation for thousands of years. Yet the source acknowledges that gold recently experienced its worst quarterly performance in 13 years.
Yeah, people were confused by that.
How is that mechanically possible? If inflation is hot, why did gold drop?
To understand the gold paradox, you have to understand the mechanics of central bank policy, specifically the actions of the Federal Reserve in the United States. Gold is fundamentally a non-yielding asset. If you hold a bar of gold in a vault, it does not pay you a quarterly dividend and it does not generate an interest yield. It just sits there.
Its only value is price appreciation.
Correct. Therefore, gold's attractiveness is always relative to the opportunity cost of holding it. When inflation spiked, the Federal Reserve became aggressively hawkish. They rapidly hiked the federal funds rate and signaled to the market that they intended to hold those interest rates at elevated levels for an extended duration.
And those interest rate hikes changed the opportunity cost equation for institutional capital.
Dramatically. If a massive pension fund or a sovereign wealth manager can purchase a virtually risk-free United States Treasury bond and lock in a guaranteed 5% annual yield, the prospect of holding a non-yielding chunk of inert gold suddenly becomes mathematically unappealing.
Yeah.
Global capital flows toward the yield. The hawkish Fed policy created an environment where the strong U.S. dollar and high Treasury yields temporarily crushed gold's momentum.
Okay, so the short-term drop was a mechanical reaction to interest rates.
Yeah.
But the analyst in the source remains incredibly bullish on gold's macro long-term trajectory. What is the fundamental counter-argument? If rates are high, why buy gold?
The bull thesis for gold relies entirely on the concept of real interest rates and the mathematical inevitability of government debt burdens.
Break down the real interest rate calculation.
The real interest rate is simply the nominal interest rate you receive on a bond minus the actual rate of inflation. We discussed earlier how inflation is establishing higher bottoms. The source argues that Western governments have accumulated such staggering levels of sovereign debt that they cannot mathematically afford to sustain interest rates at 5% or 6% indefinitely.
No, not.
The interest payments alone would consume their entire national budgets, leading to a sovereign debt crisis.
They are trapped by their own leverage.
Exactly. Therefore, the thesis is that central banks will eventually be forced to capitulate. They will have to lower interest rates to keep their governments solvent. Even if inflation remains sticky at 3% or 4%, they have to let inflation run hot to slowly inflate away the real value of the debt.
And that is the trigger for gold. If inflation is sticky at 4%, but the Fed is forced to lower bond yields to 3%, you suddenly have a negative real interest rate of 1%.
At that point, the safety of a government bond becomes a guaranteed mathematical loss of purchasing power. The opportunity cost flips. Historically, an environment characterized by negative real interest rates, slowing economic growth, and massive structural government debt is the absolute perfect macroeconomic storm for a parabolic surge in the price of gold.
And it is very clear that the major global players are actively positioning themselves for that exact storm. The source highlights the behavior of the PBOC, the People's Bank of China, as a primary indicator.
The data regarding central bank accumulation is striking. The source notes that the PBOC recently executed their largest single monthly purchase of physical gold on record. More importantly, it marked their 20th consecutive month of unbroken accumulation.
That is not a speculative trade. That is a deliberate, multi-year strategic realignment of a global superpower's balance sheet.
Yes.
They are actively de-dollarizing their reserves and migrating massive amounts of wealth into a hard asset that cannot be sanctioned or inflated away by the U.S. Federal Reserve.
And while the sovereign wealth funds are accumulating, the source analyzes the behavior of retail investors to identify where we are in the market cycle. They specifically look at the massive outflows from silver ETFs.
Yeah, the data show that everyday retail investors were dumping their silver paper assets at a record pace. On the surface, that looks like a terrible sign for precious metals. Why did the analyst in the source interpret that massive sell-off as a bullish signal?
Because it is a classic indicator of market capitulation. Capitulation is the final, agonizing stage of a bear market. It is the moment when the last remaining retail investors, the weak hands, finally experience total psychological exhaustion.
They just give up.
After years of underperformance, they throw their hands up in disgust, sell their assets at a massive loss, and swear they will never invest in the sector again.
It's the maximum point of despair.
And historically, market bottoms are forged in maximum despair. When the retail sentiment reaches that level of absolute abandonment, it signals that all the potential selling pressure has been exhausted. There is no one left to sell. The assets transfer from weak hands to strong hands, the institutional accumulators like the PBOC, setting the foundational floor for the next bull cycle.
Which creates the perfect transition into the final asset class the source analyzes, Bitcoin, the digital equivalent of gold. The source spends a significant portion of its technical analysis arguing that Bitcoin is currently sitting in a deep accumulation zone, perfectly primed for the next macro expansion.
The analysis of Bitcoin in the source relies heavily on on-chain metrics, which is a unique advantage of the cryptocurrency market. Because the Bitcoin blockchain is a completely public, transparent ledger, analysts don't have to guess about market sentiment or supply dynamics. They can mathematically verify exactly what every single coin in existence is doing at any given moment.
Let's unpack the specific metrics the source provides to justify their bullish stance. The first one is a comparative metric, the Bitcoin to gold ratio.
This is a highly instructive macro chart. Instead of pricing Bitcoin in US dollars, which introduces the variable of fiat inflation into the analysis, the ratio looks purely at the value of one hard asset against another. It measures exactly how many ounces of gold are required to purchase one single Bitcoin.
It strips the central bank money printing out of the equation entirely.
Correct. And according to the technical analysis provided in the source, this macro ratio has been in a structural upward trend for a decade. Bitcoin has vastly outperformed gold over the long term. However, the ratio recently underwent a severe cyclical correction, pulling back significantly from its all-time highs.
The source notes where that pullback stopped.
Yes, the ratio compressed down and is currently resting directly on a multi-year historical support band. Looking at the history of the asset, every single time the ratio is compressed down to this specific technical floor, it has served as a concrete launchpad. It marks the cyclical bottom before Bitcoin initiates a massive wave of outperformance relative to gold in the subsequent cycle.
So structurally, relative to its primary competitor in the hard asset space, it looks historically primed. But what about the internal metrics of the Bitcoin network itself? The source goes deep into the weeds here, mentioning several complex on-chain indicators. Let's tackle the MVRV Z-score first, because that sounds like a graduate-level statistics concept.
It is a sophisticated metric, but the underlying logic is profound for understanding market psychology. MVRV stands for market value to realized value.
Okay, let's define those two terms clearly. Market value is easy. That is just the current spot price of Bitcoin on an exchange. Multiplied by the total number of coins in existence. It's the total market cap.
Correct. Market value is highly volatile and driven by immediate daily speculation. Realized value, however, is a much deeper metric. To calculate realized value, the blockchain analyzes every single fraction of a Bitcoin, looks at the exact timestamp of when it last moved between wallets, and values that specific coin at the price it was trading at on that specific day.
So it completely ignores the current spot price and essentially calculates the aggregate cost basis of the entire network. It shows what people actually paid for their coins.
Precisely. Now, the MVRV ratio compares those two numbers. If the market value is massively higher than the realized value, it means the network as a whole is sitting on massive unrealized profit.
That's the euphoria phase. Everyone feels like a genius.
And historically, that extreme euphoria signals a cycle top. Conversely, if market value drops below realized value, it means the aggregate network is actually underwater. People are holding coins at a loss.
And the Z-score part of the metric.
The Z-score simply applies a standard deviation calculation to that ratio, smoothing out the extreme volatility to show structural deviations from the historical mean. According to the source, the current MBRV Z-score has plummeted. It has completely reset from the euphoria of the previous bull market and is resting in the lower bounds, indicating that the speculative excess has been entirely flushed from the system.
The market has cooled off. The tourists have been washed out. And this aligns perfectly with another metric the source cites, the Puel multiple.
The Puel multiple shifts the focus from the investors to the miners, the entities operating the hardware that secures the network and issues new coins.
How did that metric work?
It calculates the daily value of all newly mined Bitcoins issued into the network and compares that daily figure against the 365-day moving average of daily issuance.
Why does that matter for the price?
Miners have massive operational costs: electricity, hardware, facilities. They are a constant source of compulsory selling pressure because they have to sell a portion of the Bitcoin they mine just to keep the lights on. When the Puel multiple is very high, it means current miner revenues are vastly above historical averages.
They're flush with cash.
Right. They are highly profitable, they are selling heavily into the market, and historically this correlates with macro market tops.
And when the multiple is low?
When the Puel multiple crashes to the lower bounds, as the source indicates it currently has, it means miner revenues are severely depressed relative to historical averages. The weak, inefficient miners are forced to shut down their machines and capitulate.
Which reduces the daily compulsory selling pressure on the market.
Exactly. The compulsory sell pressure dries up. When you combine a low MVRV Z-score indicating investors have capitulated and speculative excess is gone, with a low Puel multiple indicating minor capitulation and reduced structural sell pressure, you have the mathematical definition of a sidle bottom.
The source even provides a qualitative anecdote that perfectly illustrates this on-chain data. They share a story of a retail investor publicly announcing on social media that they had just liquidated their entire Bitcoin position, realizing a massive 43% net loss, purely out of frustration with the lack of price action.
The author of the source immediately recognized that public declaration of defeat as the ultimate capitulation signal. It is the exact same psychological phenomenon we discussed with the silver ETFs. When the weak hands finally break and sell their assets at a 43% loss just to escape the psychological pain, who is buying those coins?
Strong hands. The high-conviction, long-term holders are absorbing that supply at a massive discount. The foundation is being laid.
The source aggregates all of these on-chain metrics, the MBRV, the Puel multiple, the structural support bands, into a proprietary cycle monitor that scores the market from 0 to 100. A score approaching 100 indicates absolute speculative mania and severe overvaluation. A score approaching 0 indicates maximum despair and maximum historical undervaluation.
And according to the data provided, the current score on that cycle monitor was sitting at a 16.
A 16 places the market firmly in the deepest trench of historical accumulation zones. The analysis in the source concludes that the necessary foundational reset has occurred. The weak hands are gone, the supply has transferred to conviction holders, and the metrics anticipate the cyclical compression will resolve with significant upward price momentum heading into the autumn months.
It is a remarkable synthesis of macroeconomics and granular data analysis. We have covered an immense amount of incredibly dense territory over the last hour. We have moved from the aisles of the supermarket to the halls of the Dutch Ministry of Finance, and finally into the cryptographic ledgers of global decentralized networks.
It's all connected.
If we pull all of this together, if we distill the core message of this stack of source material, the overarching theme is undeniably clear. You, the listener, are currently living through a multidimensional economic squeeze.
The environment is fundamentally hostile to passivity.
You are facing a reality where the baseline cost of your daily life has established a structurally higher floor, regardless of what the headline CPI numbers claim. You are navigating an environment where the government is actively engineering complex tax reforms, like Box 3, that seek to extract liquidity from the unrealized paper gains of your investments, threatening the very mechanics of your retirement planning. And you are doing this under the shadow of a trillion-euro demographic wealth transfer that the state is actively positioning itself to tap into via inheritance taxation.
The ultimate conclusion drawn from the material is that relying on the traditional 20th century blueprint for financial security is no longer mathematically viable. Preserving your purchasing power requires intense, active financial literacy.
You have to pay attention.
You do. It requires understanding the mechanical difference between a falling inflation rate and actual price stability. It requires acknowledging the severe guaranteed risks of holding uninvested cash in a fiat system. And it requires understanding the historical macro cycles of both traditional equities and alternative hard assets like gold and Bitcoin.
You cannot outsource your financial security to a savings account or rely on a state-managed spreadsheet to protect your legacy. You have to take active control of your capital. But as we close this deep dive, I want to leave you with one final underlying philosophical thought. It is something that permeates every single argument in the source material, but is rarely discussed explicitly in the mainstream debate.
It is the existential question regarding the nature of private property itself.
Think about the trajectory we discussed today. If a society transitions away from a model where taxation is triggered by a realized economic event, like the actual sale of a business or the liquidation of an asset, and moves toward a model that taxes the mere theoretical possession of wealth.
If the state claims the right to annually tax an unrealized paper gain on an illiquid asset or demands a massive percentage of a family business simply because the founder passes away,
does the fundamental definition of ownership change? In that paradigm, do you ever truly, completely own the assets you have built and paid for? Or does the system slowly transition into a reality where you are, in effect, just permanently leasing your own property from the state, required to pay a constantly fluctuating arbitrary annual fee simply for the privilege of holding it.
It's a profound shift in the relationship between the citizen, their capital, and the state apparatus.
And it is the exact reason why understanding these mechanics is so vital. We started this deep dive talking about the cognitive dissonance of the modern economy. Hopefully, we have managed to dissect some of those underlying forces and provided you with a much clearer map of the landscape you are navigating. Thank you for joining us on this extensive deep dive into these sources. Keep questioning the headlines, keep exploring the mechanics behind the math, and we will catch you next time.